Thank you very much, Laura, and good afternoon, everyone. It's a pleasure to be back addressing the National Press Club. I'd like to begin today by explaining yesterday's monetary policy decision. I then wanted to discuss why it's so important that we return inflation to target and the role that aggregate demand management and the expansion of the supply side of the economy can play in that task of returning inflation to target. As you would all know, at yesterday's meeting, the Reserve Bank Board held the cash rate unchanged at 3.6%. This is after interest rates were increased at our previous 10 meetings, as you can see here. The decision to hold interest rates steady this month was taken to give the Board more time to assess the economic outlook and the impact of the increases in interest rates so far. Since May last year, interest rates have been increased by 3.5 percentage points. That's a very large increase over a very short period of time, and I acknowledge that it's been very difficult for many people. The first increases were necessary to withdraw the pandemic-era support, and then the more recent increases have been required to move monetary policy into restrictive territory to deal with the highest rate of inflation that we've seen in Australia in 30 years. To be clear, the alternative to the recent increase in interest rates would have been more persistent inflation and ultimately even higher interest rates and more unemployment. So while the increases have been unwelcome by many people, they have been necessary to preserve price stability in Australia. The decision to hold rates steady this month does not imply that interest rate increases are over. Indeed, the Board expects that some further tightening of monetary policy may well be needed to return inflation to target within a reasonable time frame. The Board decided, though, it was prudent to hold rates steady this month to allow more time to assess the impact of the increases in interest rates so far and the economic outlook. The Board's very conscious that monetary policy operates with a lag and that the full effect of the increases so far is yet to be felt. It's also conscious that there are significant economic uncertainties at the moment. Given these lags and the uncertainties, the Board judged that with monetary policy now in restrictive territory, it was time to hold interest rates steady and to accumulate more information. This approach is consistent with our practice in earlier interest rate cycles. In those earlier cycles, it was common for the Board to move interest rates a few times and then sit still for a while as it accumulated more information and then move again in the same direction if the situation warranted doing so. So we're really returning to that earlier world. But given that monetary policy affects the economy and inflation with a lag and that interest rates have been increased so quickly, it's really important that the Board looks to the future when it's setting interest rates. At a meeting yesterday, we discussed a number of factors that will bear on that future, and I'd like to take this opportunity to share 3 of those factors with you today. The first is the outlook for the global economy, especially in light of the recent banking stresses in the United States and Switzerland. As you know, globally, inflation remains too high, and services price inflation is proving to be worryingly persistent. Economic growth has slowed around the world to a below-average pace, and the outlook, even before the recent banking problems in the US and Switzerland, was for below-trend growth to continue. This week and the last week, we've seen some easing in the financial stability concerns around the world, but even so, the recent problems will result in tighter financial conditions around the world as banks reassess risk and take a more cautious approach to their lending. I think it's still unclear what effect this will ultimately have on the global economy, but it's clearly another headwind.